All right, so today we're gonna dive into something that I think is pretty fundamental to all of us,
Okay.
and that's our own finances, our own personal finances.
Mhm.
And we're gonna try to approach it from a kind of a unique angle. We're gonna think of you as a business, the
Okay.
business of you, if you will,
I like it.
and we're gonna take some cues from the joy of accounting,
Okay.
um, and look at figures 4 and 5
Yeah.
and try to kind of come up with this concept of financial persona, you.
What I think is interesting about this perspective is that it allows us to apply the logic and structure of business accounting
Hmm.
to our own situation.
Right.
We have things of value,
Yeah.
we have obligations,
Yeah.
and certainly we have money coming in and money going out.
Yeah. Yeah.
And so by looking at it through this lens of the business of you, I think we can bring a surprising amount of clarity to the picture.
Yeah, absolutely. And this deep dive is all about really unpacking the core language and framework of accounting. And we're going to draw directly from the joy of accounting as we do that. And the idea is to equip you with a powerful new way to make sense of any financial information you encounter, whether it's managing your own household budget or understanding the financial health of a company that you might invest in or work for.
Right.
It's like you're gaining a superpower almost to understand this financial world.
I like that. And I think at its heart, um, accounting is a way of telling a story.
Right.
And as our source points out, it's a narrative built around two central themes.
Okay.
The first is the financial position of an entity,
Okay.
what it possesses and what it owes.
Yeah.
And the second is its financial performance.
Okay.
How effectively is it operating?
Mm-hmm.
And these two stories are primarily told through the balance sheet and the income statement.
Okay. So let's start with the absolute basics.
Okay.
What is an asset? And, when we think about assets, um, our first thought might be things like our bank account or our car or maybe our house if we own a home.
Sure.
Um, but the joy of accounting, especially when we look at figure 9, encourages us to think more broadly about what constitutes value.
Right.
They even talk about things like your talent or your personal brand as having asset-like qualities.
And what's interesting about those less conventional examples
Right.
is that it really highlights the core essence of an asset,
Okay.
something that has present or future economic value.
Right.
So think about it.
Yeah.
Can your skills or your reputation be leveraged to generate income?
Absolutely.
Absolutely.
Yeah.
A freelance consultant's expertise is a clear asset,
Yeah.
just as a popular influencer's brand is incredibly valuable.
Right.
Thinking of it this way really broadens our understanding beyond just tangible possessions.
Yeah. This brings up a really important distinction that the book makes, and that is the difference between recognized assets and unrecognized assets.
Okay.
And that just because you won't find something listed on a typical financial statement doesn't mean it has no worth.
Right.
And they give a perfect example. Coca-Cola's brand name,
There.
arguably one of their most valuable possessions.
I would agree.
Yet you won't see a specific dollar amount attached to it on their balance sheet.
Yeah, and that's largely due to what are called recognition criteria.
Okay.
So for an asset to make it onto a formal financial report,
Yeah.
it generally needs to meet two key tests.
Okay.
One, it has to be reliably measurable in monetary terms.
Okay.
And two, the entity has to have control over its future economic benefits.
I see.
So how do you definitively put a dollar value on brand loyalty? Or how can a company guarantee its continued impact?
Right.
It enters this realm of subjectivity
Right.
that accounting really tries to avoid
Yeah.
for the sake of consistency and reliability.
Right. If every company was just making up numbers for their brand value, then, financial reports would just become complete chaos.
Exactly. It'd be the Wild West.
Yeah.
Yeah.
So, the accounting profession tends to be conservative
Right.
and focus on, assets whose value can be determined with a reasonable degree of certainty
Right.
and where control is clear.
Yeah.
However, it's crucial to remember that, these unrecognized assets can be incredibly significant drivers
Absolutely.
of a company's or an individual's success.
Yes.
And, the book reminds us that while asset values are always expressed in currency units,
Right.
the process of arriving at that value can involve judgment.
Sure.
What did you pay for it?
Yeah.
What could you sell it for?
Well,
What are the market perceptions?
What are people willing to pay for it?
Yeah, yeah, exactly. Okay, so, thinking about how a business or the business of you acquires these assets,
Mm-hmm.
it doesn't happen in a vacuum.
It does not.
And The Joy of Accounting tells us that the primary way assets are obtained is by taking on obligations.
Okay.
So think of an obligation as a commitment or a responsibility or a form of debt.
Yeah.
It's a promise to do something in the future.
Mm-hmm.
And this is really critical because a lot of people mistakenly equate liabilities
Yes.
with money owed right now.
I see what you're saying. Yeah.
The book really hits this point hard.
Yeah.
An obligation isn't the cash itself.
Mm-hmm.
It's the underlying pledge or promise.
The commitment. Yeah.
Yeah. So that loan agreement you sign,
Right.
that's not the obligation itself,
Correct.
but rather the documented evidence of it.
Yes.
So it's the amount, and the terms of your commitment to repay.
Right.
And this leads us to a very foundational principle in accounting,
Okay.
the accounting duality.
All right.
Simply put, as the book states,
Okay.
rights equals obligations.
Okay.
Any economic entity at its core holds rights to its assets.
Mm-hmm.
And those assets were funded by some form of obligation,
Right.
whether to a lender or to the owner themselves. And this fundamental duality is the bedrock of the accounting equation, which brings us directly to the balance sheet.
Okay.
Now, the most basic form of this equation is assets equals obligations.
Right.
However, when we acknowledge the separation between the business and its owners,
Mm-hmm.
this expands to assets equals liabilities plus equity.
Gotcha.
And figures 24 and 25 in the book provide excellent illustrations of this structure
Okay.
for both corporate and personal financial situations.
Nice.
So let's break these components down.
Yeah.
Liabilities represent obligations to external parties.
Right.
Lenders, suppliers, anyone outside the business of you
Okay.
who has provided resources.
Gotcha.
Equity, on the other hand, represents the owner's stake in the business.
Okay.
Their residual claim on the assets after all liabilities have been settled.
Right.
So in the context of the business of you, this is your net worth.
Exactly.
And if you take your total assets and subtract your total liabilities,
Mm-hmm.
the result is your net assets, which is by definition equal to your equity. The book also introduces a helpful way to visualize this
Okay.
through what they call the color accounting system
Mm-hmm.
and highlighting sources and uses of funds.
I see.
Obligations are considered sources.
Right.
So that's the orange side of the equation,
Okay.
representing where the funding came from,
Gotcha.
while assets are the uses of those funds.
Okay.
So that's the green side,
Got it.
showing what those funds were used to acquire.
Right.
And that's depicted in figure 29.
Okay.
So think of it this way. You take out a mortgage, that's an orange source,
Right.
to buy a house, a green use.
Makes sense.
So the balance sheet gives us this financial snapshot at a specific point in time.
Okay.
But to understand how the business of you performs over a period, say a month or a year,
Right.
we need to look at the income statement.
Gotcha.
And this is where the Joy of Accounting introduces the 5-box basis framework,
Yeah.
which is figure 53. And this expands our accounting equation
Okay.
to include revenue, income, and expenses. Now, what's absolutely key here is the book's definition of revenue income.
Okay.
And it's not just about the money that lands in your account.
Hmm.
It's value-generating activity,
Right.
a verb, and action, as they emphasize.
What you get to earn the money.
Right, and they give a great example of a consultant who receives $1,000 in cash.
Okay.
That cash is an asset,
Yeah.
but the revenue is the act of providing the consulting services
interview fee.
that earn that cash.
Right.
Figure 56 really underscores this common confusion
Okay.
between, the inflow of cash and the earning of revenue.
Right. Because they're not always the same.
Exactly.
Yeah.
And just as revenue is about creating value,
Mm-hmm.
expenses are defined as value-sacrificing activity.
Yeah.
So it's the consumption of resources to generate that revenue.
Right.
So the book gives the example of a $250 taxi fare.
Okay.
The cash went out.
Right.
But the expense was the using up of that transportation service
Yeah.
that was necessary for the business activity.
Makes sense.
Now, the difference between your total revenue income and your total expenses over a period gives you your profit.
Right.
And this profit isn't just an isolated number. It directly impacts your equity through what are known as retained earnings.
Okay.
So think of retained earnings in the business of you as the accumulated profits that haven't been used for personal spending or other distributions.
Right.
So essentially, it stays within financial persona,
Sorry.
increasing your net worth.
Right.
The book also discusses profit margin
Okay.
and figure 47
Mm-hmm.
and explains that it gives crucial context to the profit figure.
Okay.
So a seemingly large profit might be less impressive if it was generated from a huge volume of activity.
Yeah, if you had to do a ton of work to get it.
Right,
Yeah.
exactly.
Yeah.
They also briefly distinguish this from markup,
Okay.
which is a related but different way of calculating profitability,
Gotcha.
often used in retail to determine selling prices.
Right.
So understanding the difference can help you evaluate, if a discount you're getting is truly significant
Right.
from the seller's perspective.
Okay.
Okay, so to really make these concepts stick,
Yeah.
the joy of accounting walks us through some fundamental classic transactions.
Nice.
So let's start with borrowing cash transaction 1.
Okay.
What's the impact on the business of you when you take out a loan, say, for $30,000?
So when you borrow cash, two things happen simultaneously.
Okay.
First, your assets increase.
Okay.
You now have $30,000 more in cash.
Right.
Second, your liabilities also increase by the same amount
Okay.
because you now have an obligation to repay that loan.
Right.
This transaction also introduces the concept of leverage, or sometimes called gearing,
Okay.
which is using borrowed funds to increase the total amount of assets you have at your disposal.
I see.
So in personal finance, a mortgage is a prime example of leverage.
Okay. Makes sense.
Yeah.
Next up is owner investment transaction 2.
All right.
How does this play out in the business of you?
So let's say you decide to put $20,000 of your personal savings into a separate account
Okay.
dedicated to a side business. You're starting.
Right.
In accounting terms, your assets cash in the business account increased by $20,000.
Okay.
And since this money came from you,
Mm.
the owner,
Right.
your equity in that side business also increases by $20,000,
Okay.
specifically as contributed equity.
Gotcha.
And so that fundamental equation, assets equals liabilities plus equity, remains perfectly balanced.
Okay. And then we have cash sale and cost of sale transactions 6A and 6B.
Okay.
This is where we really see the income statement interacting with the balance sheet
Absolutely.
for the business of you.
Yes.
So let's say you offer a service and receive $1,000 in cash immediately.
Okay.
Transaction 6A.
Mm-hmm.
This increases your cash and asset
Right.
and also increases your revenue income, which ultimately boosts your equity. But to provide that service, you might have incurred some direct costs, let's say $250 worth of materials or time.
Okay.
Transaction 6B.
Yeah.
This decreases another potential asset like supplies used
Mm-hmm.
and represents an expense, which
Yeah.
reduces your equity.
Gotcha.
The net effect, the $750 difference, is your profit from that transaction,
Okay.
directly increasing your net worth.
Makes sense.
Transactions 8A and 8B cover a credit sale and cost of sale.
All right.
How is this different from a cash sale for the business of you?
So the main difference is the timing of the cash flow.
Okay.
So in a credit sale 8A, you provide the service or the goods,
Right.
but you don't receive the cash immediately.
Right.
Instead, you create an accounts receivable,
Okay.
an asset representing the amount owed to you.
Right.
So accounts receivable increases and revenue income increases.
Okay.
Then just like with a cash sale, you would still recognize the cost of sale 8B,
Right.
decreasing your resources used,
Okay.
increasing expenses.
Got it.
The book also briefly mentions factoring,
Okay.
which is basically like selling those IOUs, accounts receivable
Right.
to someone else
Yeah.
for immediate cash, although typically at a slight discount.
Okay. Interesting.
Yeah.
Transaction 9 deals with cash received before revenue earned.
Right.
This can be a bit counterintuitive
It can.
for the business of you.
Yeah.
Imagine someone prepays you $150 for a series of coaching sessions.
Okay.
You receive the cash.
Right.
So your assets cash go up.
Yeah.
However, you haven't actually delivered the coaching yet.
Right.
So you haven't earned the revenue.
Gotcha.
Instead, you recognize a liability called deferred revenue.
Okay.
And this represents your obligation to provide those future coaching sessions.
I see.
Only as you deliver the sessions
Mm-hmm.
will that deferred revenue be recognized as actual earned revenue.
Gotcha. So receiving cash doesn't automatically equate to having earned it.
Exactly.
Right.
And finally, let's look at accrued expense transaction 13. How does the business of you account for something like this?
So an accrued expense
Hmm.
is when you've incurred an expense but haven't yet received a bill or paid for it.
Okay.
So for example, let's say you used $170 worth of freelance design services in December,
Mm-hmm.
but you won't receive the invoice until January.
Okay.
In December, you would still recognize that expense,
Okay.
which reduces your equity profit for December,
Right.
and you create a corresponding liability called accrued expenses,
Okay.
representing your obligation to pay for those services when that invoice arrives.
Gotcha. So we've covered significant ground here from,
Okay.
the fundamental definitions of accounting elements
Yeah.
to seeing how they interact through these common financial activities,
Right.
all within this context of the business of you. So what's the ultimate value for our listener in understanding all this?
Well, the real value lies in gaining financial literacy and empowerment
Okay.
by grasping these basic accounting principles. You're better equipped to understand your own financial situation,
Right.
make informed decisions about saving, spending, investing,
Mm.
and even critically evaluate financial information you encounter in your professional life.
Yeah.
As the joy of accounting aptly puts it, accounting truly acts as the glue that holds civilization together.
Wow.
By providing this framework for accountability and transparency
Mm-hmm.
in financial matters,
Mm-hmm.
whether it's a large corporation or the business of you.
Absolutely. I mean, without this understanding, you navigating this financial world can feel like you're just trying to find your way in the dark.
Yeah, absolutely.
But now you have a framework.
You have a map.
You have a way to see the underlying structure at
Exactly.
these financial stories.
Yes.
So as we conclude this deep dive,
Hmm.
we hope you're starting to view your own financial life through this accounting lens.
Yeah.
And by understanding the core concepts of assets, obligations, revenue, and expenses, you now have this powerful tool for analyzing your own financial situation with greater confidence and clarity.
You got it.
And on that note, here's a final thought for you to consider.
Okay.
How can truly embracing this concept of the business of you fundamentally reshape how you approach your personal financial decisions?
Mm-hmm.
Take a moment to think about your own personal balance sheet.
Okay.
What do your assets and liabilities look like?
All right.
And what about your income statement?
Mm.
What are your primary ways of generating value, and what are those inevitable value sacrifices?
Interesting.
Perhaps even more intriguingly,
Okay.
what might be your most valuable, unrecognized assets?
I like that.
Those skills relationships or potential that aren't yet reflected in your bank balance,
Right.
but hold significant future value.
It's a whole new way to tell your financial story.
It is. Yeah, I like it. All right, well, thanks for joining us on this deep dive,
My pleasure.
and we'll see you next time.
Sounds good.